You're watching Morning Markets on BNN Bloomberg. I'm John Ehrlichman. We are seeing positive action overall for North American stocks today. And in the U.S., we've got the S&P 500 up 45 points, almost 1%. The NASDAQ even stronger in percentage terms. And one standout stock is Novo Nordisk. Now, this is the company behind Ozempic. That's Eli Lilly, which makes a rival product. But there's been an equally exciting tone around these obesity treatments. But in the case of Novo Nordisk was MVO in New York, trades as an ADR because it's a European company. Shares are already up, I think, 30% this year and about 100% over the last year. And today, the surge has been tied to the potential of its next generation obesity treatments. The company releasing some promising data on an experimental daily pill. And here's a company, a Danish company that is trying to keep the lead in the growing market for obesity treatments. Let's bring in Bob Iaccino of Path Trading Partners for a little bit more context on the movers today. Bob, it is nice to see you. And I know that so much of the market attention right now is on these crazy advances in AI-related stocks. But this is equally fascinating to talk about, the rapid run-up in the obesity drug plays. What do you make of what's happened with stocks like Novo Nordisk?
Yeah, hey, John, I think if you sort of surveyed the general public, you'd find more general interest in obesity drugs than you would in AI. I think more people are using obesity drugs than are at the point of using AI already at this point. Having said that, I personally don't get involved in these stocks. Now, it's impossible to ignore the moves. The moves are on real earnings and real sales estimates that have been ramped up and real results in terms of weight loss on the drugs. But whenever you see something like this, where you've got a situation where pharmaceuticals are taking place for a healthier lifestyle, it troubles me because we don't have long-term trials on any of these drugs. We have medium-term trials. And I'm old enough to remember some drugs in the past that were approved and then got taken off the market because of adverse health effects. So that keeps me out of this kind of a trade longer term, or I should say investment longer term. But for a trade, if there's a pullback, I would definitely take advantage of it.
Okay, since we talked a little bit about AI by comparison, I just wanted to highlight for our audience what's happening with Micron technology today. Given that you've had stocks like NVIDIA that have had such a huge run and that name getting to another record today, you have this conversation on Wall Street around other AI plays. And one analyst at Stifel today making headlines calling Micron their latest call on the AI phenomenon. I'm not sure if we can show our audience what's happening with Micron shares, but needless to say, there's some positive action in that one. What do you make of not just the NVIDIA phenomenon, but now everybody looking for the next AI winner?
Well, I think that's typical of human behavior when it comes to investing. It reminds me of when silver reached $50 a bunch of years back because gold was rallying and then it never really held on. NVIDIA has such a head start that if you want to get involved in NVIDIA, or I should say AI chips, you probably should get involved in a pullback in NVIDIA because Micron's going up in sympathy. I understand some of these calls. Again, it's the only way to get sort of on top of a better return for some of these that might rise in sympathy, but you might be better off looking at something like ASML traded in New York because they make lithography equipment and software for AI chips. And that might be a better play than just getting involved with other chip companies, hoping they catch up to NVIDIA at some point.
Now, it's not as exciting as AI, but the grocery business is getting an awful lot of attention as technology this year. That's true here in Canada. You've got big players like Loblaw that have seen their stock moving higher. And then we were talking with Nora Melinda from Bloomberg earlier on BNN Bloomberg about a big move higher in Kroger shares today. What do you make of the phenomenon of excitement around tech and excitement around consumer staples simultaneously?
Well, it shows a reflation narrative, if you ask me. We're entering a reflation regime. And when you've got services spending and services inflation that has been as sticky as it has, the last services spending number was up about 6.3%. If you do a 6-month annualized calculation, services spending is going to come in about 7.1% if it continues at this pace. That money will continue to drive services inflation, which again is the stickier side of inflation, higher. And if that's the case, groceries are already starting to ramp up a little bit, and grocery chains will get the runoff from people who've decided to stop spending on food services. So it's a really good trade. And by the way, the PE ratio is closer to 11, which, for value investors, that's an attractive place to get into any stock. So if you're a value investor, grocery stores might be the place to go. And Kroger's a really strong one. They have a strong business, they have a strong brand, they have a strong private label. So it's a good one to get involved in. But again, I'm always looking for pullbacks. And when you see a move like you saw today, I might wait till that dividend gets paid out and then get in at that point.
Okay, so let's talk about some areas that you're quite constructive on, starting with an individual name. Our audience is very curious about the energy sector in the U.S. Diamondback Energy is a stock that you've been watching. How come?
I like the energy sector, and that'll make people in Canada smile, I think. I like it a lot, and I like it right now because, again, I think we're entering a regime where growth is going to accelerate and inflation is going to accelerate as well, so a reflation regime. And when that happens, if you look at an equity sector back test, energy is the best performer in those types of scenarios. Now, you look at somebody like Diamondback Energy, FANG is a symbol, you're talking about a lower break even, one of the lowest break evens for the non-integrateds. They're somewhere around $40, $50 a barrel where they get break even, so they can literally drill as much as they can and sell at a higher profit margin than, say, an Exxon or a Chevron. If you compare them on the chart, you'll see that FANG outperforms them when prices are rising, and then they kind of level off when prices are falling. So I like that name a lot, especially if I'm right that inflation is going to continue to rise. You saw yesterday Jerome Powell saying that they don't need 2% inflation to cut rates. Well, that's just going to spark inflation even more, in my opinion. So if you get a rate cut where we still have, even at the weakest reading of core inflation, 2.8%, you're going to see some energy stocks rise on that, and FANG's my favorite.
And then a sector that we don't talk as much about, but you're watching is biotech. How come?
Okay, so number one, same reason. If we're in an inflation narrative, technology in general is one of the better performers, in biotech within technology. It gives one of the better reward profiles. Now, not necessarily risk reward, because I need to explain to people that biotech, you can't separate risk and reward. So if you're going to get a double or even a triple digit return on something, you're going to get a like risk with that. But having said that, it's above my pay grade to pick a good biotech company, but I still want to get exposure to it. So I want to look at biotech ETFs, which we did, and we recommended to buy a couple of days ago. Actually, it was the beginning of March that we recommended to buy in this particular ETF, the XBI. So I think that's going to also continue. I'm looking at somewhere on that particular XBI of about 131 is my target on it. It's trading somewhere around 90 and change right now. So I think there's a decent return that can come in that. If I'm right, that growth is going to continue to accelerate and inflation is going to continue to accelerate. And, productivity is the key, right? If you sort of extrapolate out maybe a 1% productivity growth, which is reasonable, you're talking about GDP in the U.S. being somewhere around 3.2%, which is above average.